大家好，我是 Jessica。这一份财务报表的英文版呢，是针对以后如果想要到银行的外商公司，那一定要看英文版的财务报表而设计的。这份财务报表的英文版是用英文的解说，那会在荧幕上用中文翻译。
What are financial statements? Financial statements are written records that convey the financial activities of a company. Financial statements are often audited by government agencies or accountants to ensure accuracy and for tax, financing, or investing purposes. For-profit primary financial statements include the balance sheet, income statement, statement of cash flow, and statement of changes in equity. Non-profit entities use a similar but different set of financial statements. Key takeaways: financial statements provide interested parties with the company's overall financial condition and profitability. Statements required by generally accepted accounting principles are the balance sheet, the income statements, and the statement of cash flows, but you'll likely see more in the reports. The balance sheet provides an overview of assets, liabilities, and shareholders' equity as a snapshot in time. The income statement primarily focuses on the company's revenues and expenses during a particular period. Once expenses are subtracted from revenues, the statement produces a company's profit figure called net income. The cash flow statements, CFS, tracks how a company uses its cash to pay its debt obligations and fund its operating expenses and investments. Understanding financial statements. Investors and financial analysts rely on financial data to analyze a company's performance and make predictions about the future direction of its stock price. One of the most important resources of reliable and audited financial data is the annual report, which contains the firm's financial statements. The financial statements are used by investors, market analysts, and creditors to evaluate a company's financial health and earnings potential. The three major financial statement reports are the balance sheet, income statement, and the statement of cash flows. Not all financial statements are created equally. The rules used by US companies are called generally accepted accounting principles, while the rules often used by international companies are international financial reporting standards, IFRS. In addition, US government agencies use a different set of financial reporting rules. Assets. Cash and cash equivalents are liquid assets, which may include treasury bills and certificates of deposit. Accounts receivable are the amount of money owed to the company by its customers for the sale of its products and services. Inventory is the goods a company has on hand, intended to be sold as a course of business. Inventory may include finished goods, work in progress that is not yet finished, or raw materials on hand that have yet to be worked. Prepaid expenses are costs paid in advance of when they are due. These expenses are recorded as an asset because their value has not yet been recognized. Should the benefit not be recognized, the company would theoretically be due a refund. Property, plant, and equipment are capital assets owned by a company for its long-term benefit. This includes buildings used for manufacturing or heavy machinery used for processing raw materials. Investments are assets held for speculative future growth. These aren't used in operations, they are simply held for capital appreciation. Trademarks, patents, goodwill, and other intangible assets can't physically be touched, but have future economic and often long-term benefits for the company. Liabilities. Accounts payable are the bills due as part of a business's operations. This includes utility bills, rent invoices, and obligations to buy raw materials. Wages payable are payments due to staff or for time worked. Notes payable are recorded debt instruments that record official debt agreements, including the payment schedule and amount. Dividends payable are dividends that have been declared to be awarded to shareholders but have not yet been paid. Long-term debt can include a variety of obligations, including sinking bond funds, mortgages, and other loans that are due in their entirety in more than 1 year. Note that the short-term portion of this debt is recorded as a current liability. Shareholders' equity. The shareholders' equity is a company's total assets minus its total liabilities. Shareholders' equity, also known as stockholders' equity, represents the amount of money that would be returned to shareholders if all of the assets were liquidated and all debts paid off. Retained earnings are part of the shareholders' equity and are the amount of net earnings that were not paid to shareholders as dividends. Income statement. Unlike the balance sheet, the income statement covers a range of time, which is a year for annual financial statements and a quarter for quarterly financial statements. The income statement provides an overview of revenues, expenses, net income, and earnings per share. Revenue. Operating revenue is the revenue earned by selling a company's products or services. The operating revenue for an auto manufacturer would be realized through the production and sale of autos. Operating revenue is generated from the core business activities of a company. Non-operating revenue is the income earned from non-core business activities. These revenues fall outside the primary function of the business. Some non-operating revenue examples include interest earned on cash in the bank, rental income from a property, income from strategic partnership like royalty payment receipts, income from an advertisement display located on the company's property. Other income is the revenue earned from other activities. Other income could include gains from the sale of long-term assets such as land, vehicles, or a subsidiary. Expenses. Primary expenses are incurred during the process of earning revenue from the primary activity of the business. Expenses include the cost of goods sold, COGS, selling, general and administrative expenses, SG&A, depreciation and amortization, and research and development (R&D). Typical expenses include employee wages, sales commissions, and utilities such as electricity and transportation. Expenses that are linked to secondary activities include interest paid on loans or debt. Losses from the sale of an asset are also recorded as expenses. The main purpose of the income statement is to convey details of profitability and the financial results of business activities. However, it can be very effective in showing whether sales or revenue is increasing when compared over multiple periods. Investors can also see how well a company's management is controlling expenses to determine whether a company's efforts in reducing the cost of sales might boost profits over time. Cash flow statement. The cash flow statement, CFS, shows how cash flows throughout a company. The cash flow statement complements the balance sheet and income statement. The CFS allows investors to understand how a company's operations are running, where its money is coming from, and how money is being spent. The CFS also provides insight as to whether a company is on a solid financial footing. The cash flow statements contains 3 sections that report on the various activities for which a company uses its cash. Those 3 components of the CFS are listed below. Operating activities. The operating activities on the CFS include any sources and uses of cash from running the business and selling its products or services. Cash from operations includes any changes made in cash accounts receivable, depreciation, inventory, and accounts payable. These transactions also include wages, income tax payments, interest payments, rent, and cash receipts from the sale of a product or service. Investing activities. Investing activities include any sources and uses of cash from a company's investments in the long-term future. A purchase or sale of an asset, loans made to vendors or received from customers, or any payments related to a merger or acquisition are included in this category. Also, purchases of fixed assets such as property, plant and equipment, PPE, are included in this section. In short, changes in equipment, assets or investments relate to cash from investing. Financing activities. Cash from financing activities includes the cash from investors or banks and the cash paid to shareholders. Financing activities include debt issuance, equity issuance, stock repurchases, loans, dividends paid, and debt repayments. The cash flow statement reconciles the income statement with the balance sheet in 3 major business activities. Statement of changes in shareholder equity. The statement of changes in equity tracks total equity over time. This information ties back to a balance sheet for the same period. The ending balance on the change of equity statement equals the total equity reported on the balance sheet. The formula for changes to shareholder equity will vary from company to company. In general, there are a couple of components. Beginning equity. This is the equity at the end of the last period that simply rolls to the start of the next period. Net income. This is the amount of income the company earned in a given period. The proceeds from operations are automatically recognized as equity in the company, and this income is rolled into retained earnings at year end. Dividends. This is the amount of money that is paid out to shareholders from profits instead of keeping all of a company's profits. The company may choose to give some profits away to investors. Other comprehensive income. This is the period-over-period change in other comprehensive income. Depending on transactions, this figure may be an addition or subtraction from equity. Statement of comprehensive income. An often less utilized financial statement, the statement of comprehensive income, summarizes standard net income while also incorporating changes in other comprehensive income, OCI. Other comprehensive income includes all unrealized gains and losses that are not reported on the income statement. This financial statement shows a company's total change in income, even gains and losses that have yet to be recorded in accordance with accounting rules. Examples of transactions that are reported on the statement of comprehensive income include net income from the statement of income, unrealized gains or losses from debt securities, unrealized gains or losses from derivative instruments, unrealized translation adjustments due to foreign currency, unrealized gains or losses from retirement programs. Limitations of financial statements. Although financial statements provide a wealth of information on a company, they do have limitations. The statements are often interpreted differently, so investors often draw divergent conclusions about a company's financial performance. For example, some investors might want stock repurchases, while others might prefer to see that money invested on long-term assets. A company's debt level might be fine for one investor, while another might have concerns about the level of debt for the company. When analyzing financial statements, it's important to compare multiple periods to determine any trends and compare the company's results to its peers in the same industry. Lastly, financial statements are only as reliable as the information fed into the reports. Too often, it's been documented that fraudulent financial activity or poor control oversight have led to misstated financial statements intended to mislead users. Even when analyzing audited financial statements, there is a level of trust that users must place in the validity of the report and the figures being shown. What are the main types of financial statements? The three main types of financial statements are the balance sheet, the income statement, and the cash flow statement. These three statements together show the assets and liabilities of a business, its revenues and costs, as well as its cash flows from operating, investing, and financing activities. What are the benefits of financial statements? Financial statements show how a business operates. It provides insight into how much and how a business generates revenues, what the cost of doing business is, how efficiently it manages its cash, and what its assets and liabilities are. Financial statements provide all the details on how well or poorly a company manages itself. How do you read financial statements? Financial statements are read in several different ways. First, financial statements can be compared to prior periods to understand changes over time better. Financial statements are also read by comparing the results to competitors or other industry participants. By comparing financial statements to other companies, analysts can get a better sense of which companies are performing the best and which are lagging behind the rest of the industry. Profitability. Higher margins and returns generally indicate a more profitable and efficient business. Gross profit margin. Revenue, cost of goods sold divided by revenue. Operating profit margin. Operating income divided by revenue. Net profit margin. Net income divided by revenue. Return on assets, ROA. Net income divided by average total assets. Return on equity, ROE. Net income divided by average shareholders' equity. Liquidity. A higher ratio suggests that the company has enough liquidity to cover its near-term liabilities. Current ratio. Current assets divided by current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable divided by current liabilities. Solvency. These ratios measure a company's liability to meet its long-term debt obligations. Lower debt ratios and higher interest coverage ratios generally indicate a more financially stable company. Debt to equity ratio. Total liabilities divided by total shareholders' equity. Debt to assets ratio. Total liabilities divided by total assets. Interest coverage ratio. Operating income divided by interest expense. Efficiency. These ratios measure how effectively a company manages its assets to generate sales. Higher turnover ratios suggest that a company is using its assets more efficiently to generate revenue. Asset turnover ratio. Revenue divided by average ratio assets. Inventory turnover ratio. Cost of goods sold divided by average inventory. Receivables turnover ratio. Revenue divided by average accounts receivable. Valuation. Lower ratios may indicate that the stock is undervalued, while higher ratios may suggest that it is overvalued. PE. Market price per share divided by earnings per share. Price to book, PB ratio. Market price per share divided by book value per share. Price to sales, PS ratio. Market price per share revenue divided by revenue per share. Dividend yield. Annual dividends per share divided by market price per share.
如果以上有任何错误的地方，欢迎留言订正指教，谢谢。